There are two people sitting in the same break room at the same company, earning the same salary, eating lunch at the same table. One of them got a flat tire this morning. It cost $340. For one of them, that's an annoying Tuesday. For the other, it's a quiet crisis, a mental recalculation that starts the moment they hand over the card and doesn't stop until payday. Same job, same income, same parking lot. Two completely different financial realities separated by a single number, and that number isn't $1 million, it isn't even 100,000. It's $20,000 sitting in a savings account, and the distance between those two people at that lunch table is larger than almost anything else in personal finance. My name is Anderson, and today I want to show you exactly what $20,000 does to a life, not what it buys, but what it dismantles. Because the more interesting story isn't about the person who has it, it's about the system that was built specifically around the person who doesn't. Before we get into what $20,000 changes, I want to name what life looks like without it clearly, specifically without softening it, because most people living inside it have adapted to it so completely, they've stopped recognizing it as a condition rather than just reality. Below $20,000 in liquid savings, your financial life runs on a calculation that never stops. You're not budgeting in any intentional sense. You're doing constant triage, gas or groceries this week, this bill now or that one later, how many days until the deposit clears? Every unexpected expense arrives not as an inconvenience, but as a threat. The car repair, the dental bill, the appliance that dies on a Saturday, each one triggers the same sequence. Where does this money come from? What does paying it delay? And how long until the account recovers? Princeton economist Senthil Mullainathan spent years studying this mental state and found something that should change how you think about financial stress entirely. He discovered that financial scarcity doesn't just cause stress, it consumes cognitive bandwidth the way a demanding task consumes attention. People managing persistent financial precarity aren't less capable. They're running a mental background process that never closes, and it costs them measurably in focus, decision quality, and long-term thinking. The stress isn't a side effect of being below $20,000, it is a tax, a real, invisible daily tax on your mental capacity that the balance sheet never shows, but your life absolutely pays. Approximately 60% of Americans are living some version of this right now, not because they lack intelligence or work ethic, because the gap between their income and this threshold has never been crossed, and as I'll show you in a moment, crossing it is precisely what the financial system is not designed to help you do. What $20,000 actually changes? The number itself, $20,000, represents roughly 4 to 6 months of living expenses for most people. That translation matters more than the raw figure, because what 4 to 6 months of expenses in reserve actually does is convert a category of events from crises into inconveniences. The car repair becomes a savings transfer. The medical bill becomes a manageable payment plan you choose rather than a debt you're forced into. The job loss, the thing that keeps more people trapped in bad workplaces than almost any other factor, becomes a period of evaluation rather than a period of desperation. You can take 3 weeks to find the right next role instead of accepting the first offer that comes along because rent is due in 11 days. That shift crisis to inconvenience sounds simple. It is not simple. It is one of the most profound changes in daily psychological experience that a financial milestone can produce. The low-level alarm that financial precarity keeps running in the background of your mind goes quiet. Not permanently, not completely, but enough that you start making decisions from a different cognitive place than you were before. Decisions that look further ahead. Decisions that evaluate trade-offs instead of just reacting to immediate pressure. Decisions that compound forward rather than just prevent the immediate worst case. This is what $20,000 actually buys, not security in an abstract sense. A specific, neurological quieting of the scarcity alarm and everything that becomes possible when that alarm isn't running. The business model built on your side of the line. Now here's the part that reframes the entire picture. Your bank is not a neutral party in your financial well-being. It is a profit-maximizing institution, and the profit structure of retail banking is built substantially systematically on customers who remain below this threshold. The first mechanism is overdraft fees. American banks collected approximately $7.7 billion in overdraft fees in a single recent year. That number doesn't come from wealthy customers. It comes almost entirely from people whose account balances regularly approach zero. People who have a $5 shortfall when a payment clears and pay $35 for the privilege of being briefly broke, sometimes multiple times in a single day, because multiple payments clear against the same insufficient balance. The bank covers the shortfall and charges you for the service. Once you have $20,000 sitting in savings, you never overdraft again. That buffer is permanent. That revenue stream from you goes to zero, and structurally, you have become a less profitable customer overnight. The second mechanism is what I'd call urgency pricing. When you need money immediately and have nothing saved, your negotiating position is non-existent, and every lender in the market knows it. Payday lenders charge effective annual rates that can reach 300 to 400%. Title loans put your vehicle at risk. Even conventional personal loans carry significantly higher rates for borrowers without a savings cushion because the risk premium reflects your actual position. The financial system doesn't charge you more because it dislikes you. It charges you more because your desperation is accurately priced into every product you're offered. When you have $20,000, that desperation disappears entirely as a variable. You need $2,000 for an emergency, you transfer it from savings, repay yourself over a few months, and the transaction costs exactly nothing. No interest, no application, no lender profits from your urgency because your urgency no longer exists. The third mechanism is the one the credit card industry named with remarkable candor. Customers who pay their balance in full every month, collect rewards, and never pay interest have an industry term applied to them internally: deadbeats. That's the actual word used within the business to describe unprofitable cardholders. Think about what that label reveals about the product design. The card is built to be profitable when you carry a balance, when the gap between your spending and your savings forces you to pay minimums and let interest accumulate. The average American carrying credit card debt pays over $1,000 a year in pure interest charges, not for purchases, not for value received, just for the timing gap between buying something and being able to pay for it. Below $20,000 in savings, most people carry balances because there is no alternative. Above that, you pay in full every month. You are, from their perspective, a deadbeat. Wear that label as the compliment it accidentally is. If this is landing for you, if you're starting to see the structure underneath what felt like personal financial struggle, take 2 seconds and hit the like button. It genuinely helps this content find more people who need it. The leverage question nobody asks. Beyond the fee structures and interest rates, there's a more diffuse but equally important shift that $20,000 produces. It moves leverage. Think about where leverage actually lives in your daily financial life. Your employer has leverage over you when missing one paycheck would break something. Your landlord has leverage when you cannot afford to relocate and have no buffer to absorb a sudden rent increase. The car dealer has leverage when you need a vehicle this week and cannot credibly walk away from the negotiation. Every counterparty in every significant financial transaction, consciously or not, is reading whether you have the ability to say no. And the price you pay, in almost every context, is shaped by how convincingly you can walk away. $20,000 does not make you wealthy, but it makes you genuinely able to say no to the job that has been treating you as replaceable because you've had no alternative, to the financing offer structured to benefit the lender, to every transaction where your previous urgency was being priced in against you without you ever seeing the line item. Consider the workplace example specifically because I think it's the most emotionally resonant version of this. You know the job you've stayed in longer than you should have. The environment that was slowly becoming something you didn't recognize yourself in, the manager whose behavior you'd never tolerate in any other context of your life, The reason most people stay isn't complexity. It's that one missed paycheck, just one, would create a chain reaction they can't absorb. $20,000 breaks that chain entirely. You can give notice today. You have months of runway to find something that actually fits. Your employer's leverage over you evaporated not because your circumstances changed dramatically, but because one number in one account crossed one threshold. That is what financial security actually does in practice, not luxury, negotiating position. The quiet power of someone who doesn't need this particular deal badly enough to accept bad terms. How to get there. The honest version. I want to be direct about this because most advice on building savings either oversimplifies the math or ignores the psychology entirely. The path to $20,000 is not complicated, it is not fast, and the difficulty is not primarily mathematical, it's behavioral. Because you are trying to consistently redirect money toward a future reward in an environment designed to extract it toward immediate consumption at every point of decision. Here is what works, specifically and mechanically. The first move is to make the contribution automatic and invisible. The day your income arrives, a fixed amount needs to move to a separate savings account before you interact with your checking balance. Not whatever is left over after the month. Not a manual transfer when you remember. An automatic, scheduled, non-negotiable movement of money that happens before you make a single spending decision. Even $50 a month automated is more powerful than $200 moved manually when circumstances allow, because automation removes willpower from the equation entirely, and willpower is not a reliable financial strategy. The second move is to treat windfalls as milestone accelerators rather than lifestyle upgrades. A tax refund, a bonus, a gift, an unexpected extra income. Each of these represents compressed time on the path to $20,000. A $2,000 tax refund redirected entirely to savings is roughly 4 months of a $500 monthly contribution arrived all at once. The version of you that spends the refund arrives at the end of the year in the same place. The version that redirects it arrives 4 months closer to a threshold that changes the texture of daily life. The third move is to find one structural expense, not a daily purchase, something recurring that costs more than it returns, and redirect it. A subscription you've mentally demoted to background, a service you've been meaning to cancel for 6 months, a membership that peaked in value 18 months ago. Most people have between 1 and 3 of these, and the combined monthly total is often larger than they expect. Redirect it specifically by name to the savings goal. Give it a destination rather than just an intention. The fourth move, and this is the one that separates the people who get there from the people who restart every few months, is to protect the account from yourself during the building phase. Keep it at a different institution than your checking account. Make the transfer. Take 24 hours. Add enough friction that accessing it requires a decision rather than a reflex. The emergency fund is for emergencies, not for a deal that feels urgent, not for a want that arrived disguised as a need. Friction is a feature, not an inconvenience. Back to the break room. The person with the flat tire who had a quiet crisis this morning, that's not a permanent condition. It's a position, a specific, addressable, mathematical distance from a threshold that changes almost everything about how daily financial life feels and functions. The bank built its fee structure around people staying on that side of the line. The lenders price their products for people who have no alternative. The entire consumer financial system runs more profitably when 60% of Americans remain below the threshold where they become difficult to extract money from. Every dollar that moves into that savings account is a dollar the system cannot reach. Every month the balance grows and the alarm runs a little quieter. Every small automated contribution is a structural decision that compounds forward not just financially, but psychologically, behaviorally, in every negotiation and opportunity and moment of choice that follows. $20,000 is not the end of the story. It is the end of the first chapter, the one where you were playing defense without knowing the rules of the game you were in. What comes after it is a different conversation entirely, but you have to get there first. The 4 years it takes to build it are going to pass regardless. Where you are standing when they do is the only variable still in play. If this is the kind of content that actually moves the needle for you, consider subscribing. New video every week. I'd rather it find you than miss you. My name is Anderson. I'll see you in the next one.